Okay, let's unpack this.
Let's do it.
We're diving into the prepared remarks, and just the prepared remarks. No Q&A from a major financial company's Q3 presentation, CEO and CFO laying out the quarter.
Right.
And our goal here for you listening is to quickly pull out the core story. Where's the real, sustainable, innovative growth and profitability? What's the key message?
Yeah, that's the mission.
Yeah.
And right off the bat, CEO Scott Sanborn didn't really hold back. He called it an outstanding quarter.
Strong words. Did the numbers back that up?
Well, yeah, the headlines are pretty explosive. You've got 37% growth in origination,
Okay.
32% growth in revenue,
Right.
and diluted earnings per share, nearly tripling year over year.
Wow, okay. Tripling EPS. Those are definitely strong numbers. But, the immediate question that pops up, especially in this kind of environment, is how? How are they doing that without, taking on a ton of risk when others seem to be struggling a bit?
That's exactly what makes this interesting. The CEO tackled that head on. He said it's not just one thing, not a silver bullet. It's more like a convergence, he said, of competitive advantages. Things like their member base, 5 billion strong now.
Okay.
Sophisticated product innovation, which we'll get into, really consistent credit outperformance compared to peers,
Crucial.
and, critically important, a resilient balance sheet. It's how these pieces fit together, he argued, that creates that durable growth story.
Okay, that makes sense. It sets the stage really well. So let's dig into that first piece for the volume, the originations. How do they achieve that?
Right, so the hard number for Q3 originations was $2.62 billion,
Okay.
which notably was above the top end of their own guidance range. So they outperformed their own expectations.
Always good to see. And what drove that?
They pointed to strong demand, really from both sides.
Yeah.
Consumers wanting loans and loan investors wanting to buy them.
Got it. But, volume is one thing. You mentioned the competitive advantages. Where does that show up here?
Yeah, the volume's great, but here's where it gets structurally interesting, I think. The value proposition.
Oh.
The CEO shared this really telling stat. He said when their loan offers are shown side by side with competitors on like a major loan comparison website, they're closing, on average, 50% more customers.
Wait, hang on. 50% more.
50%.
That's not just a slightly better rate. That points to something much bigger, maybe in the whole user experience or the trust factor.
Exactly. It implies their offer, maybe the rate, maybe the terms, maybe the speed, is significantly more compelling.
And think about the implications for customer acquisition cost, the CAE, if you convert 50% better.
Your cost to acquire that customer just plummets compared to the competition.
Right. That's a massive efficiency advantage, a huge barrier for anyone trying to compete.
Precisely. That superior conversion, that's the engine for efficient growth. But crucially, they're pairing it with discipline.
Okay, the risk side.
Yeah, the commitment to disciplined underwriting. They're delivering roughly 40% outperformance on credit versus their competitor set.
40% better credit outcomes.
That's what they reported. So they're managing to find this path, grow fast, and keep credit losses significantly lower than peers. That's the tightrope everyone tries to walk.
And very few manage it that well. Okay, so connect that strong credit performance to the balance sheet then. How does that play out?
Well, if your assets are performing better, you can confidently grow your balance sheet, Razi's. And theirs has now grown to over $11 billion.
11 billion.
And this is where having that bank charter, being a regulated financial institution, really becomes a strategic moat.
How so?
Because they can fund those high-quality loans partly with stable, insured deposits. Deposits are generally a much cheaper and more reliable source of funding than, say, the wholesale markets that non-banks often have to rely on.
Right, especially when markets get volatile.
Exactly. So that strong balance sheet, that favorable funding mix, it resulted in their highest ever net interest income, or NII.
Okay, what was the number?
$158 million for the quarter. That's, a really durable, resilient revenue stream built on that stability.
That non-banks just can't easily match.
Pretty much. But they're not just holding loans. The other side of the model, the marketplace, is also doing really well.
Okay, the marketplace. What happened there?
Marketplace revenue grew 75%.
75%. Wow.
Yeah, highest level in 3 years. And they hit a record for structured certificate sales, over $1 billion sold through the marketplace.
$1 billion in structured certificates. So they're successfully selling loans off too. Attracting capital is clearly a big focus.
Huge focus. And here's where it gets really strategic, I think. They announced an MU, a Memorandum of Understanding, with funds managed by BlackRock.
BlackRock. Okay, that's a big name.
Right. To purchase up to $1 billion in loans through their marketplace programs running through 2026.
So locking in a major institutional buyer for the longer term?
Exactly. It's not just a one-off deal. It signals long-term confidence and provides funding certainty. And there's more. They're developing a new rated product.
Rated, meaning it gets a credit rating.
Correct. Specifically designed to attract insurance capital. Insurers are massive capital pools, but they often need rated assets for regulatory reasons.
Ah, so they're tailoring the product to unlock a whole new class of investor.
Precisely. It's about optimizing who buys their loans and at what price, further boosting that marketplace revenue and efficiency. Very sophisticated funding strategy.
Okay, this sophisticated funding, the strong NII, it all supports the overall scalability. Which brings us to the CFO's part of the presentation, confirming the financial strength.
Yeah, the CFO, Andrew LeBen, really underscored the scalability. Pre-provision net revenue, PPNR, grew 58% to $104 million.
And just quickly, TPNR, that's basically core operating profit before you account for loan losses, right? A measure of underlying health.
Exactly. It shows you the earnings power of the core business, stripping out the volatility of credit provisions for a moment. And the other key metric, return on tangible common equity, ROTCE.
The one shareholders watch closely.
That hit 13.2%, nearly tripled year over year.
Tripled ROTCE. Okay, so the model is definitely generating strong profits on the equity deployed.
Clearly showing serious earnings power is scaling up.
All right, let's shift gears a bit from the pure financials. How are they planning to keep this going? What about the customer side, the member engagement strategy?
Right, because growth needs to be sustainable. The CEO, Scott Sanborn, actually said he was equally excited about this, the member engagement, the flywheel effect they're building.
Flywheel? Yeah, what drives that?
He pointed specifically to the mobile app and high engagement products, particularly Level Up Checking and another one called Debt IQ.
Okay, Level Up Checking. Let's dive into that one. It launched recently, right?
Yeah, launched back in June. And the adoption's been pretty remarkable. A 7-fold increase in account openings compared to their previous checking product.
7 times. That's huge uptake.
Massive. But here's the really clever part, the integration piece.
Okay.
Level Up Checking offers 2% cash back, but only for making on-time payments on their loans held with the company.
Ah, so it's not just a checking account perk. It's directly incentivizing good borrower behavior.
Exactly. They are literally paying customers, rewarding them for reducing the bank's credit risk. It's brilliant, really.
Does it work? Did they share any data on whether that influences borrowing decisions?
They did. A survey showed 84% of respondents said they were more likely to consider a loan because of that 2% cashback offer linked to the checking account.
84%. So the checking account becomes a marketing tool for the loan product while also de-risking it.
Precisely. It's not just a separate product line. It's integrated. It's a risk-mitigating marketing tool.
And are existing borrowers signing up for this checking account?
Yeah, that's another key data point. Nearly 60% of the new Level Up checking accounts are being opened by people who already have loans with them.
Okay, so the integration is definitely happening. People are seeing the benefit.
And the payoff, they say, is significant. Monthly app logins from borrowers, up nearly 50%.
50% increase in app engagement from borrowers.
And that higher engagement translates directly into lower cost acquisition over time. Repeat members, engaged members, cost much less to service and cross-sell to than acquiring brand new customers from scratch.
Right. That's the flywheel they're talking about. Engagement drives retention, drives lower CAC, funds more growth.
That's the concept. Keep the members engaged, deepen the relationship, lower your costs.
Okay, let's bring it back to the CFO, Andrew LeBen, and the specific numbers supporting this whole picture.
Right, so he detailed the dual revenue streams. Non-interest income, that's mainly the marketplace stuff, grew 75% to $108 million.
Okay.
Now, we should note there was about a $5 million benefit in there from a fair value adjustment because benchmark rates came down a bit.
Ah, technical adjustment. Good to know.
Yeah, but even backing that out, the underlying growth trajectory is still really strong.
And that's layered on top of the other revenue stream.
The net interest income, the NII, which we already mentioned, hit that all-time high of $158 million.
So both sides of the revenue equation firing. What about the funding side specifics? Deposits, margins?
Also looking very strong. The net interest margin, or NM, basically the profitability of their lending, improved to 6.2%.
6.2% NM is pretty healthy.
Very healthy. Total deposits reached $9.4 billion. And that Level Up savings product, the companion to checking, is nearing $3 billion in balances and accounted for most of the deposit growth this year.
So the new products are successfully gathering deposits.
So. And he also mentioned the efficiency ratio is getting close to its all-time best level. So costs are being well managed relative to revenue.
Okay, comprehensive picture. But we always have to talk about credit health, the risk. What were the current metrics?
The net charge-off ratio, that's loans actually written off as losses, improved slightly again this quarter, down to 2.9%.
2.9%, still relatively low.
Yes, performance is strong right now. But importantly, the CFO gave a very clear, transparent warning.
Oh, what was that?
He basically said, look, we expect this charge-off ratio to tick back up towards more normalized levels as these newer loans, the recent vintages, mature over time. That's just the natural life cycle of loans.
Okay, so managing expectations, they're not promising 2.9% forever.
Exactly. But crucially, he added that these expected future dynamics are already factored in to the $46 million provision for credit losses they took this quarter.
So they're provisioning proactively for expected future normalization, not just reacting to current low losses.
That's the message. It signals disciplined, forward-looking risk management. They're trying to stay ahead of the curve.
Got it. Okay, so with all that momentum, the strong financials, the risk management, what's the outlook? What did they guide for Q4?
The CFO laid out guidance that expects, well, continued momentum, maybe slightly adjusted for seasonality, but still strong year-over-year growth.
Numbers.
Originations expected between $2.5 and $2.6 billion. That's still up 35% to 41% year-over-year.
Still very solid growth.
Yep. And PPNR, that pre-provision profit, expected between $90 and $100 million. And interestingly, they specifically called out two assumptions baked into that forecast.
Which were?
One, they're assuming 2 interest rate cuts from the Fed in Q4.
Okay, building in some rate relief.
And 2, the outlook includes increased marketing investment. They explicitly said this was to position the company not just for Q4, but laying the groundwork for growth in 2026.
Thinking further ahead already. Interesting. Okay, that seems like a pretty thorough pass through the prepared remarks. If you had to synthesize the core message, what is it?
I think the core message hammered home was that this isn't just growth for growth's sake. It's about profitable, risk-managed expansion.
Right.
They kept emphasizing how they're leveraging their proprietary credit models, that unique integrated bank and marketplace structure, essentially using their specific advantages to grow in ways or in segments where competitors maybe can't or aren't willing to go right now.
A story of differentiation and execution.
Absolutely.
Yeah.
And they stressed they're well-capitalized, sitting on $11.1 billion in assets. They feel that gives them immense flexibility to fund future growth organically without needing to go out and raise more capital right now.
So operational stability, strong capital, clear strategy, backed by that integrated product design.
Yeah, that product design piece feels central. The CEO kept coming back to it, that intentional design, creating this behavioral flywheel to boost lifetime value.
Right. Which leaves us with a final thought, maybe for you listening to consider. If this flywheel effect using products like Level Up Checking to incentivize behavior is working, as they say, how much further could it drive down customer acquisition costs as more of that 5 million member base adopts these integrated products?
It's a great question. Could that become their primary competitive advantage?
Exactly. We talked about disciplined underwriting leading to better credit outcomes, but given how they're linking it to product perks, is disciplined underwriting actually becoming their ultimate marketing tool? Something to ponder.